Hello and welcome back to the Black Enterprise Wealth Building and Real Estate Summit. I hope you've enjoyed our conversations today. This is a very important one. I'm Alfred, Edmond Jr., Senior Vice President of Black Enterprise and Executive Editor at Large. And we are here to talk about opportunities in crisis, investing in the COVID market. We have two really strong panels to have this conversation. Cassandra Cummings, founder of the Stocks and Stilettos Society, and Allan Boomer, Managing Partner and Chief Investment Officer of Momentum Advisors. Welcome to this conversation, people.
Thank you. Thanks for having me.
Thanks for having us, man.
So listen, let me just set it up at the top. I mean, this whole summit is about closing the racial wealth gap, really focusing on wealth creation, multi-generational wealth creation in Black America and the Black community. We cannot do that without being engaged in the stock market in any number of ways. One of the biggest challenges we've had historically is either we're not in the markets or we get in at the wrong time and then get out at the wrong time, which reinforces our desire not to be in the markets because we feel like we're not really benefiting from that participation. I'd like each of you, and I want to start with Cassandra, to talk about what you've been doing to help educate the people that are involved in your organization who take your classes about investing in the stock markets and its importance to really creating multi-generational wealth.
Yes, well, thank you so much, Alfred, for having me again. We've been doing a lot of work inside of the Stocks and Stilettos Society to really have women overcome their fear of investing. And so during a pandemic, such as what we're in right now, women are really looking for alternative sources of income because a lot of people are getting laid off. They're waiting for these stymie checks to come. They're taking forever, and they're really just not enough to care for their families. And so inside of the society, we've been talking about the different types of companies to get involved with. We've had a number of stay-at-home companies, such as the Zooms and Targets and things like that, DoorDash, companies that really have been thriving during this pandemic and really allowing them to understand that there's still money to be made even in crises. And so that's what we've been sort of communicating with our Stocks to Stars, as we call them, inside of the society, and really helping guide them into the market gradually, especially if this is their first time investing.
Yeah, Allan, talk about that. Cassandra made a great point about one gradual to, we have this image mostly from media and movies that you find some hot stock and you buy it and then you're, overnight millionaire or overnight bust. But we're talking about many ways, whether it's through mutual funds or retirement plans at our companies, we have access to them, ways that we can get in where we can fit in, ways that are affordable, and most of all, with the idea of investing over time, that this is about what we can do over a long time horizon. So Allan, talk about helping our audience get a better understanding that we're not just talking about finding that one hot stock and riding it to billionaire status. We're talking about consistent investing over time to build wealth and build assets.
Absolutely. First of all, thanks for having me. It's always a great time hanging out with the Black Enterprise crew here. But you hit it on the head. Investing, if you really break it down, is all about mixing your money with an opportunity and then giving it time. The challenge with today's environment, we've had a lot of people who just started investing start to have some expectations that investing is about doubling or tripling your money in a matter of weeks or days. You've had GameStop run up, which the good thing about that is it drew attention to the stock market. It was a draw for people who maybe never were interested in Wall Street. The bad thing is that there were some people that might have thought that's how the market works, that you put money in, even to a company that is not doing well. And if enough people get excited and the stock's going to keep going up, our worry is that folks are getting introduced to investing in the wrong way. Investing is about time. And I'll give you an example. The stock market over time, if you give it enough time, generally trends to go up. And it's usually like in the range of like 7 to 10% a year. That's so meaning like if you start with $1,000, you're making $100 of profit. I think a lot of people are like, I'm going to take 1,000 and flip it to 100,000 in a year. Like that is not typical. It might have happened in GameStop. It might have happened in Bitcoin or Ethereum, but that's not how typical investing works. You really have to give your investment enough time. And so that's the major thing that I want listeners to, and the people watching this to really key in on, is that you've got to be patient. It really is true that slow and steady wins the race. And there's a notion of compound interest. Compound interest is they call it the eighth wonder of the world. And there's a saying that he or she who understands it profits from it. He or she who doesn't, they pay it, right? There are credit card companies who are profiting from compound interest, where we as investors need to be thinking about how do we profit? And really that's from, as you mentioned, investing in small increments, consistently, giving your investments enough time, and watching that beauty of compound interest work in your favor.
And Cassandra, building on that, also talk about the importance of diversification, and both of you can weigh in, starting with Cassandra, but I want to talk about diversification in two ways. And I'm speaking to this because it also helps to mitigate our fear of risk. One is diversification within the markets, meaning you're not trying to find that one hot company. You want some exposure across multiple sectors so that as the economy fluctuates for all kinds of reasons, some things are going to go up and some things are going to go down, but overall you're going to have a positive outcome. And the other thing, and we'll talk about that more deeply into this conversation, is not about having all your money in the stock market and not anywhere else. That diversification is both other investment vehicles, even though for this conversation, we want people to understand the importance of being in the markets. What do you teach your students, the people who come to the Stocks and Stilettos Society, about diversification and how that also helps to mitigate some of the fears of investing?
Well, Alfred, I mean, you should be in the society teaching, because you just hit the nail on the head as well with that. So diversification helps to mitigate risk. It's not going to eliminate it in totality, but it will eliminate your fear of having, one sector blow up on you or something like that. And we teach our students there are 11 sectors. So there's a lot of choice in the market. It's like, a supermarket. We have different aisles and different sections. We got the produce section, the meat section, the deli section. The stock market is really set up similarly. We've got real estate, we've got information technology, we've got consumer discretionary. So we've got 11 sectors, utilities. We've got a lot of different sectors that we can invest in. So being able to spread our money over a lot of different areas helps us to mitigate risk, because some sectors may be more subjective to seasonality than other sectors. And so it's good to be able to take advantage and ride some of those waves when certain seasons hit. Now, the other thing that you did speak about was different asset classes, right? And this really speaks to multiple income streams, right? We talk about that a lot. You hear about millionaires having 7 income streams, right? The average millionaire actually has 3 income streams. And so when we talk about diversifying not only our stock portfolio, we also should be talking about diversifying our asset portfolio. So that may be looking at spreading our money in the stock market, but maybe having stocks and some bonds and maybe some precious metals. We can even spread it over REITs, real estate investment trusts. So there are also different types of asset classes within the stock market that we can also spread our money across to also bring down our risk of losing our money or losing our skirt, as I usually say to our ladies.
I want to build on that analogy. I like it, of the stock market being a lot like a supermarket. And Allan, if we were looking at food and with the food on our plate, we wouldn't just have only meat on the plate. Like, we wouldn't just have a plate, all we ate every day was meat. We say, no, we need some meat, we need some vegetables, we need some fruit. Maybe you can have a little dessert, maybe, because a real healthy, well-rounded diet has different food elements. And it sounds like the same thing with the stock market. You don't want to just say, oh, I'm going to go all the way into tech. I'm going to go all the way into Bitcoin. I'm only going to do real estate. I'm only going to do this. So Allan, talk about the importance of communicating this idea of diversification, spreading risk, because the thing is, the economy is going to do what it's going to do. Companies are going to do what they're going to do. Some of them are going to be up and down. No one predicted a pandemic, but the pandemic was great for some companies and not so great for others. But help dig deeper into this idea of diversification as a way to get past the fears of what might happen this month or next week versus what's going to happen over the next 10 years.
Yeah, I think you're bringing up a great point. Like diversification is like the best defense for everything that's unexpected that's happening in the future. We've talked a lot today about stocks. I think when people think about investing, they automatically think about stocks, but bonds are really important, and bonds don't get a ton of attention. You know, bonds are an investment that not everybody understands. But a bond is like a CD from a bank. Like I think a lot of folks understand the concept of a CD. With a CD, you put up your money, you get your money back plus interest. There's a guarantee there that you're going to get your money back plus some interest on top. Bonds are safe, right? And the reason they don't get a lot of attention is that nobody's getting wealthy from owning bonds. But everybody should own bonds, right? We talk about bonds as being like eating vegetables or taking vitamins. Like everybody should do it. And the older you get, you need to do more of it. So a little rule of thumb we give investors when they're thinking about how do I construct a portfolio of stocks and bonds. I know there's other stuff too, but let's just think about these big groups, right? So stocks, we call those high risk, high reward investments. A lot of attention gets focused on stocks. Bonds are low risk, low reward, right? Bonds, again, are your vegetables or your vitamins. And a little rule of thumb, if you don't know how to pick what percentage should go into each category, think about your age and match your age to your bond percentage. This is an old school rule of thumb. It's not an exact law, but it generally gets you in a portfolio that fits your retirement, right? So if you are 30 years old, then you put 30% in bonds and 70% in stocks. Once you get to be 50 years old, maybe you're now half and half. When you're 60 years old, now you're 60% in bonds and 40% in stock. It's this idea that as you get older, as you get closer to retirement, as you get closer to that great day when you can live on your investments and you're no longer working for your money is exclusively working for you, it's designed to keep you out of trouble. And I want to give you a quick stat. So during the financial crisis of 2008 to 2009, that was a 3-year period where the stock market was down. And from top to bottom, the market was down about 50%. So if you had invested 100K, you were down to $47,000 if you had invested all in stocks. And eventually it would recover, but it took a full 3 years. You didn't make your money back from March of 09 until about 2012 if you were completely in the stock market. So 3 years, right? The worst economic environment we've ever experienced since the Great Depression. In 3 years, you got your money back, right? Now, what if you added in some bonds? Like what if you had 40% in bonds, 60% in stocks? That's like your 40-year-old's portfolio. That portfolio still would have declined. It would have dropped, instead of going down 50, maybe it would have dropped about 30, but it would have recovered in 18 months, half the time. Right now, if we take it a little bit further to a more of the grandma portfolio, right? Or the granddad portfolio, 60% in bonds, 40% in stocks. So the majority in conservative or safe investments, that portfolio would have only dropped about 12%. And in just 6 months, the same calendar year, you would have been back to ground zero. So this idea of diversification, yes, you want to diversify within stocks. And I think there was a great point about the different sectors of the stock market, but you also want to be diversified by owning some bonds. And that diversification buys you less downside risk, faster time to recovery. And the third thing is that you can actually outperform by being diversified. You can do better than that risky portfolio by having some safer investments built in.
You know, I'm glad you brought up that particular economic period because I just think that period really illustrated, it's probably not the only period that illustrated this, but that one really illustrated this. When the economy went down, everybody felt it. But our audience might want to remember that recovery was called a jobless recovery. So to your point, Cassandra, if you had all your eggs in the income basket, meaning you were hoping your job came back or you were left out of the recovery. But if you were in the markets, the recovery was a market recovery. The people who were invested are the ones who experienced the comeback, the recovery from the recession. Eventually the jobs came back, but they came back for different people in different ways, and it took a lot longer. So it was a graphic example in my own mind of how everybody was hit by the recession, but the people that recovered most rapidly were the people that had some investment. They weren't just totally reliant on the income from their job as their main source of quote unquote wealth capital.
Yes, and I would also add too, when we had the Corona correction back in March of 2020, it was one of the fastest recovery periods that we have ever seen. And so if you were invested even during that time period, your money recovered relatively quickly. So I think that, you have to not only get in the market, but you got to have stick-to-itiveness, because the market always turns around. Some of the bears, which are the pessimists of the market, right? They view the market as crashing or going down. They tend to have a shorter run than the bulls, who are more optimistic, really looking for the stock market to boom and provide great returns. The bulls always seem to come roaring back strong after the bears have had their short period of time in the market.
We talk about it because a lot of stock market investing is emotional, because we know. And if you're super risk averse, as African Americans in particular tend to be historically, and I'm going to state this premise, and you guys can jump in terms of how true it still is and what degree it's a challenge we need to overcome. If you are in the market and you get fearful when the market does go down for whatever reason, and then you get out of it, you're likely selling high, and when you should be buying low. I don't know if I'm explaining it. In other words, when the market's down, you should be buying.
Right.
But often because of fear, we're selling. We're selling out. And then when we get excited about a stock that's on its way up, and we think we're catching it on the way up, but often the value or the appreciation of the stock has already taken place because we waited to get in.
Yeah, I'll jump in on that. I think it's a great point. There are studies that show you cannot time the market.
Exactly.
And if you got a feeling or a hunch that now's a great time to get out, you're probably wrong. Like, I remember the last time I got that feeling. Remember the day after Donald Trump was elected? Remember how you felt as a Black person? Like, man, it's about to get tough out here. If you sold your stock portfolio at that time, you missed a great run in the stock market. It's impossible to know. And it's not because of Donald Trump that the market did well. It's because we were in the midst of a great recovery already. The economy was expanding. There's always so many factors at play. You really never know. So your best defense is to stay diversified and to stay invested. And if you're constantly adding to your portfolio, you're buying during those times when the market's going down. I promise you, if you try to time the market, you're going to be wrong. Cassandra, am I right on that?
You're absolutely right. I mean, it's not timing the market, it's time in the market. And it goes back to what you mentioned earlier, is that you have to give it time. It's like baking a cake, right? You've got to put all of the ingredients together, put it in the oven. You can't put it in there for like 2 minutes and take it out, right? It's not going to be ready. You've got to get it time to cook, to get moist and just delicious, right? Can you tell I'm a little hungry? I've been talking about food.
I want some cake now. I'm ready.
Right? And so, yeah, so you have to give the market time. And like I tell my ladies inside of the society, investing can get boring. It's almost like watching paint dry, because you're waiting for your portfolio to really take off. And that's when the compound interest really takes effect. Once it's had time to marinate, right? To really work on your money. And so you really have to be patient, and investing is a long game.
Yeah,
hey, can I jump in on that question also, Alfred? I'm sorry to cut you off, Alfred and Cassandra. You mentioned this notion of Black folks being risk averse. Like we're when we think of investing, a lot of us automatically go to Las Vegas in our minds. Like it's risky. It's betting it all. You could lose. Like I think a lot of us have a word association. You say investing, they say lose, right? Because we've experienced that. But the challenge to being risk averse is this: there's a silent killer of your money. There's a thief in the night that right now is siphoning away money from your bank account, and it's called inflation. Inflation is the idea that every year life gets more expensive. Like think back, Cassandra, back in the day when you could buy a slice of pizza, how much was it back in the day?
We used to
$1?
get pizza from Blondie's in Berkeley for $1.
And if Blondie's is still there, you go there now and try to put down $1 on the counter and see what it gets you. Maybe it's $3 now. So meaning if you just put your money in the bank, and today banks are paying less than 0.5% in terms of the interest rate on a savings account. Inflation is taking 2% of your money every year, right? So that means the $100 that you saved is really worth 98 the next year. It's worth 95 in a couple years. Eventually it's worth $50, right? And so we've got to think about the risk of being safe, right? Like the risk of just sitting on our money under the mattress or in the savings account, that's a risk too. Investing will counteract that. Like investing will help you to keep pace with inflation, but hopefully to beat out on inflation so that when you go back to Blondie's to get that slice of pizza, you've got enough cash to cover it.
Definitely.
You know, this idea of stock market investing being exciting, which is fed by culture, let's face it. If there's a movie about stock market investing, it's not about somebody sitting patiently for 30 years waiting for the interest to compound. No, it's the story about Facebook. It's the story about, the Wolf on Wall Street and, parties and, mansions and yachts. So part of it is that. And so often, especially, I'm gonna say this among men, I think women are more patient investors than men. That's my opinion. If it's not that exciting, if it's not like we're gaming the system, then we're like, that's not, one of the things I experienced during this pandemic, I got such comfort in just checking my 401k, man. And like, it's doing good, it's doing fine. And so I always say, balance off this idea of excitement with peace of mind as you're looking over time from year to year to year, as you're steadily putting money toward the market, whether it's through your 401k, through a mutual fund or some other vehicle, or you're buying individual stocks. And I use the stock apps that you just automatically invest on your phone. I use them all because I do like when I get anxious looking and say, oh, well, it's still going up, so I guess it's okay, But talk about, Allan, both of you have raised an idea of changing our emotional perspective around investing from it being about risk to being about reward over time. Mm-hmm. Either of you can jump in on that, Cassandra.
Yes, I mean, I think that you have to have that balance. When it comes to investing, you really have to check your emotions. Emotions can drive you to make irrational decisions. And so you have to understand that money doesn't have emotion, you do. And so in order for you to let your money work for you, I always tell the ladies that, stocks are sexy and investing is all about self-care. And so when you think about investing from that standpoint, it gives you a different type of attachment to money that maybe you hadn't grown up with, right? Our relationship with money changes over time. And so if you take care of your money by way of investing, that money is going to one day turn around and take care of you. And so that's what I really communicate and articulate to my ladies.
And if I could jump in on that point as well, and I want to give a numeric example, and let me first give an analogy, then I'll give a numeric example. Think about if you owned a cow and the cow produces milk and you take that milk and you drink some, you make some cheese and you sell it at the market, you might sell some milk. Every year that cow is producing milk that you can live on. As long as you don't kill that cow, you'll be taken care of forever. Assuming a cow can live forever. It's an analogy. Just go with me here for a second. So or a chicken. Imagine a chicken that's laying eggs and you're eating some, you're growing more chickens with some, you're selling some down at the market, but you still got your base of chickens that's producing. So think about the milk or the eggs. Think about that as dividends and interest. And our goal needs to be that one day our entire income, all of our expenses are met by the dividends and interest on our portfolio. If we can build up a big enough cow, one day we'll be able to live on just the interest and dividends that the cow produces, just the milk that you pull from the cow. And then your kids will inherit the cow, which will also take care of them. But it's not a sexy thing. It's a short-term thing it's a long-term thing. And the numeric example is this. If you invested for 30 years, every week, $100 a week, on average, you're saving about $5,000 every year, $5,200 a year. Over 30 years, you've saved $150,000, right? That's pretty good. That's assuming you just put it in, a savings account or put it in your checking account. But imagine if you invested that money and imagine you got a 7% rate of return. How much money do you think you'll have? Alfred, I'm putting you on the spot. How much would you guess you have at the end of 30 years? I got to put you on the spot, man. 30 years, $100 a week. How much do you have at the end of 30 years? Ballpark. You've saved 150K. So hopefully it's more than that. How much? You're earning 7% a year.
4 million. I'm just thinking about this guy.
That's a great number. I wish it was 4. It's over $500,000. Meaning like your 150 has more than tripled by just giving it some time. So you know what people say, time is money? When it comes to investing, time actually is money. Time will help you to triple your investment if you give it enough time.
I know we're using, all these now. We got food analogies and eggs and milk, but I love it because I think it's a way that any average person can understand it. And what it came to me when I finally got it, because I wasn't raised with this. This is revelations. Thank God I worked at Black Enterprise because I learned a lot of this because I became an employee at Black Enterprise. But if you take seeds, you can eat them, which is what we do, or you can eat the cow and just and then you have to work to get another cow because you just eat steak, but you got to, but the cow is not doing anything for you other than feeding you day to day. Or you can take the seeds and store them, which is putting them in a savings account, and you're not eating them, you're not storing them, they're there, but they're not doing anything for you. Or you can plant them. And again, planting them creates not only fruit, dividends, but every fruit has more seeds that you then can either store, eat, or plant. And one of the things I've been saying in terms of the young people I mentor, and even my kids, is like, don't eat all the seeds, and don't just put them, don't just store them, plant them, and the planting is the investing.
It's a great analogy.
See, I had to jump in. You had your supermarket. I had to throw one in.
I like Cassandra's pizza.
What I like about this conversation is that we're really demystifying what has been very much a mystified, culturally, socially, media-wise mystified thing, when it really is about feeding the cow and getting a big enough cow so you can live off the milk, or live off the eggs, or and talk about diversification, having enough the right kinds of food so you have a healthy financial diet that again you can live on when either you don't want to work for income anymore or you can't work for income anymore. Right. And of course, the big thing, and this conference is about multi-generational wealth. You can't pass your job on to your kids, no matter how great your job is, no matter how well it pays, no matter what the benefits are, but you can pass on assets. And so we're talking about multi-generational wealth, whether you talk about stocks, bonds, and some of the other sessions we talk about real estate, or even a business, those are assets that can be passed on. So when we're talking about closing this net worth gap, you're not doing that without assets that you can pass on, that you can put into a will, that you can protect and put to use long after you don't need to eat or drink anymore because you've transitioned. Talk about, and Cassandra, I want to start with you on this question. What are the biggest questions that beginners have? Because of people who are new, that you have to kind of get them past to get them to the point of actually becoming active investors?
The biggest question I get is, how much money do I need to get started? And so because of micro investing apps like Acorns and Stash App, you really don't need a whole lot of money to get started. So you can get started with as little as $5. But I think, doing something like what Allan said, having a consistent contribution amount, $100 a week, $500 a month, whatever that will be, you need to sort of identify what that is. And I always say, you don't want to invest using mailbox money. So this is money that you don't need to pay your light bill. You don't need to feed your children. This is money that you can not necessarily afford to lose, because that really kind of like stings when people hear that. But it's money that's going to be put away to help you take care of yourself, like you said, when you're not able to work later in life, right? So you're putting this money away to take care of your older self. And so a lot of times people just need to get started. So if it's $20, $5, $2,000, get started with what you have available to get started with.
Yeah, and I would add on that note, that point about mailbox money, that's a powerful message that you just gave. You've got to put your emergency money off to the side, right? Like you've got to have at least 3 months worth of expenses.
See, I
Where
say
6 months, let's go with 6.
Hey, look how
I
long
say
it's been in the pandemic.
absolutely.
Man, you guys are conservative. I go 9, 12.
Yeah, I usually say
more
But
conservative.
3 is a good start. 3 is a good start.
three to start. A lot of us couldn't cover a month.
True.
Unfortunately, right? So start with that baby goal of 3 months. We're gonna work to Cassandra's goal of 6 months. We're gonna get to Alfred's goal of 9 months, and the stretch goal is 12 months, right? Like you want to be able to cover your living expenses, because the one thing that's guaranteed is that there will be an emergency, right? And if there's an emergency and you don't have some reserves, you now have to go and cash in on your investment. And what happens is a lot of times these emergencies coincide with dips in the economy. Like I lost my job because of COVID, so now I don't have money to pay my rent. So now I need to go take money out of my 401k, which is also down. It's the worst time to be selling. And so think about your savings as like defense. If we were playing football, you need a defense that's going to protect, the other team from scoring points on you, right? And so that cash keeps you to be able to withstand those 30 years to make sure that you can stay invested the whole time. It keeps you from having to go out and get a credit card and pay 20% interest on that money. That cash needs to sit there and do nothing, and you got to be comfortable. We've got to normalize this idea of seeing a few months worth of living expenses sitting in cash in your account.
Well, you want to park it in high yield online savings accounts, because you're going to get a much more attractive interest rate than just at the brick and mortar bank. So I definitely say seek out those higher interest savings accounts as well, or you can lock in.
I like the online savings account for my emergency fund, not only for the reasons that you guys have laid out, but because in mine, I don't have an ATM attached to it. Like to get to it, it's not like just run and get it. I have to take some steps to move it from one place to another. So it makes me less likely to just dip into it, whether it's because of a crisis or an impulse or whatever. It has to be a real crisis for me to get to it. I want to touch on something else that I think that's important, that I wish I had adopted earlier in life, because people talk about, well, I don't have money to invest. And I always tell people the money to invest is what you can save. Like that's why saving is important. That's why being able to cut expenses is important. And the best piece of advice I ever heard that I wish I had gotten earlier in life was bank your raises. Like if you've been used to living on $40,000 a year and you get either a new job or a promotion or a raise, stay living on $40,000 a year and try to go a year without spending the extra, whatever it is, because that builds your savings, and that savings becomes your pool for investing, especially if you've already got your emergency fund. Talk about the correlation between having saving discipline so that you do end up having money that you can actually budget. You should be able to budget your investing like you budget your light bill. I pay my light bill and $100 is going toward this investment through the vehicle I've set up. But talk about the correlation between saving and investing, because you can't save, you're always going to save, no matter how much money you make. And I know people that make $500,000 a year that say, I don't have money to invest, but they don't have money to invest because their living expenses is escalating faster than their income is growing.
Well, I think there's an adage that we hear time and time again: pay yourself first. This really speaks to that, because how much are you worth, right? If you were the utility company, if you were the light company, put Cassandra down there, and then that should be 10%. And you should have that line item on your budget or what have you, and 10% should be invested.
It's future Cassandra.
Yes, future
Invest in the future,
Cassandra.
Cassandra.
Yeah, absolutely. And so you should have that money invested. There was a study done by Fidelity that says women, especially women, because we have so many other factors. We live longer than men. We usually make less than our male counterparts. We are not in the workforce as long as men. We average about 27 years in the workforce versus men who average about 40 years in the workforce. So we have a lot of dynamics that are working against us. And so we really have to be vigilant about saving that extra 10% for ourselves every single pay period, month, quarter, whatever the case may be. When we close a real estate deal, what have you. And so with that 10%, in this study, it says this is what women need to do, these three things to be financially stress-free. They have to build that emergency fund that we talked about just a moment ago, and they have to save 10% of their income. The other thing they have to do is they have to get help, get a financial plan. And I would say a fourth thing is that you've got to get around like-minded people so that you can continue continue having these conversations. It's really key, right? They say that you're the average of like the 5 people you hang out with or something to that effect. So you want to get around people who are having these money conversations so that you can learn from them and you can pick up tips along the way. So I applaud Black Enterprise for putting together this Wealth Summit.
Well,
Absolutely.
you.
And on that note of that 10%
Yeah.
example, I think 10% is a great number. Your 401k can be a place for investment. And I think in our community, the 401k gets it gets a bad rap in a lot of ways, right? People say, I don't trust my company. I'm not giving them my 401k. Well, you're not really giving it to your company. Your company is, orchestrated a plan so that you can put money away, but you're not giving it to it's for you. It's absolutely for you. So another one you hear, I don't get a match, so I'm not going to put anything in, as if they're punishing someone other than themselves, right? Like you're going to be the one that's 65 years old one day with no money, right? Like there used to be a thing called a pension. Like my dad worked for 32 years for UPS. He retired, he got a pension. He also got Social Security, right? The pension and the Social Security was enough for him to really live. Now, if it wasn't, now 401k used to be the icing on the cake. Like 401k would be, your pension covers maybe half your old salary. Social Security might cover 20%. Now you're up to 70%. 401k used to be just that little stopgap to cover the 30%. Well, what's happened today? What's happened in the last 20 years, 30 years? Pensions are gone. Like barely anybody has a pension now, unless you work for a city, a state, your teacher, fireman, policeman. There aren't many career paths today that give you a pension. So pension's gone. Social Security is at risk. Like Cassandra, you and I both got the same letter that said they're going to run out of money by the time we need to take Social Security. So now what used to be the icing on the cake is the entire cake. Right. And so you've got to think about that 401k. And the thing about the 401k that's beautiful about it, the taxes are deferred. So that issue of compounding, you're benefiting from over time. It's an automatic investment program where, X% is going in, whether you want to or not, every paycheck. So it keeps you honest. Number 3, you can't just go to an ATM and take that money out. There's some tax deferral built in. Tax benefits built in. But the final thing that nobody talks about, it's creditor protection. Mm-hmm. Did you know that your IRA or your 401k is one of the few assets that no creditor could ever take from you? Meaning, if you had $1 million in your 401k and you filed for bankruptcy because you had credit card debt and mortgage debt and all sorts of things, you'd come out of that bankruptcy with $1 million in retirement dollars. What other asset can you own that has that protection from creditors? So it gets a bad rap. We need to really embrace this idea of investing through a 401k, also investing outside of it. I'm not saying that's the only place where you should invest, but we can't overlook that. We've got to max out. To max out, you can put away up to $20,000 or so. Like that's maxing out, not how much it takes to get the match from your employer. Your employer won't be there with you, when you're 70 years old, but try to get as close as you can to maxing out. That puts you in a much better position to have a good retirement down the road.
Yeah, you really want to
Go ahead,
I
Cassandra.
just want to piggyback off what he said. You really want to better understand how that 401k works, because a lot of us, that's our first introduction to the stock market, right? We get hired, they give us a packet, they tell us, click these links, go online, set up your 401k, and we really don't get, hand holding on how to get it set up, what investments to pick. So you really have to take that 401 very seriously. And I even teach a class that's called Slay Your 401k, that really breaks down the intricacies of how to set up your 401k plan to really suit you. And this works for 401k, or if you're in government, your thrift savings plan, your TSP. I think they get a little bit more of direction and guidance with their TSP account than the people that work in the private sector. But it's really a vehicle that really doesn't get a lot of attention. We just set it up, put it on autopilot. I'm going to save $200 a pay period. And we really don't take that 401k into, serious consideration. And we really need to do
We're
so.
really spoiled at Black Enterprise, because I've been in our 401k at Black Enterprise at least 25 years. And
Wow.
every year they bring people in to talk to us about what it is, what's available to us, what are the changes in the plan. I mean, that education part is really important. So what you guys do is important. In the few minutes we have left, I want to hit one more important point. I think one of you guys touched on the idea of having a plan. And I always tell people it starts with qualified professional who can put together a plan before you start buying products. And it's a marketplace. So a bunch of people, it's like, so buy this, buy that, buy this, buy that. And people reach out to me on social media and say, well, what should I buy? And I'm like, it depends on what your situation is.
Right.
So talk the importance about, you start with a plan, and the plan is how you eventually decide how much stocks or bonds or what should you have, because it's based on your individual goals. There's no one size fits all. So I'm a big champion of the idea that you should have financial planning and the help of a qualified financial planner if you can do that.
Right. It's just like getting in a car, right? You get in the car, you're trying to go to your destination, right? You need a roadmap. Your financial plan gives you that roadmap. It tells you when to turn left, when to turn right, how many miles you have to go up the road. And it's going to be the same thing that gets applied to your financial plan. How much do you need to save? How should your investments be structured? How long should you be saving? Things like that. And
But when the unexpected happens, what's the detour?
Right. You get a detour, right? You get a yield sign or something like that along the way, because sometimes we have to come out of the workforce, not by choice, but by force. And so how do we plan for these types of provisions? Because like Allan said earlier, life happens. And so how do we build that in to our financial plan, our investment plan, to make sure that we don't take a huge step back should one of these things happen? So planning is sort of where I come out of, my financial advisement experience, is that we always started with a plan because we needed to know where we're starting with, right? So start with where you are, and then what's that final destination? What are you trying to get to? Is it the $1 million? Is it early retirement? What does that look like for you? It's going to be different for everybody.
Yeah, on that note, I'm sorry, Albert, you go, and then
jump in,
Alfred.
Yeah.
Brother Alfred, I appreciate you, man. I'm sorry for jumping in on you, man. I was just going to make the point on planning is that everybody needs a plan. Not everybody needs a financial advisor or a financial planner. Okay. Like, we're now in an environment where you can find a wealth of information online. There's great podcasts out there. I'll give a shout to the Momentum Advisors podcast, which you can find. Shameless plug. But there's so much information out there that you really can do a lot of planning on your own, right? You don't really need, like, often when people come to me and say, hey, I think I'm ready for a financial advisor, and we talk for a few minutes and I uncover that they don't have an emergency fund. They've got $20,000 in credit card debt. They're not contributing to their 401k plan. They don't have life insurance. Like the four things that we just described, and it's a lot of what Cassandra talked about easing that financial anxiety. A lot of those things you could do on your own without paying someone right? Like, don't pay, in my opinion, you shouldn't pay someone for them to tell you to save your money. Like, I'll tell you right now how to save your money. Don't pay someone to tell you to save your money. Like, because when you're out, like, you're in control of your wallet. Like, you can tell yourself, okay, here's how much I can afford to spend on this or that, better than a third party can come in and tell you what to do. I was on a call yesterday with a client and we were going through their budget, and they're telling their expenses, and I'm like, oh, you shouldn't have your kid in this expensive summer camp, find something less expensive. They were like, what do you like? You can't tell me now. So it's like, what you want to do with your money. Like, don't go to someone else for them to tell you how to spend your money. Maybe someone can give you some pointers. Like, the pointers we offered were, if you were to focus on paying off your credit card, you're freeing up $1,500 a month that you can use towards additional saving and investing. That sort of help, can come from a professional, but the basics of, I need to save, I need to pay off credit card debt, we need to really try to work on a lot of that stuff on our own.
Listen, guys, this was such a powerful conversation. As you know, this is Black Enterprise's mission. It's your mission too. So we're all going to keep doing this work. It's so important. But I thank you both for really underscoring why it's important for us to really get serious about investing as a community if we are really going to improve this major wealth gap that everybody reports on. We're not going to fix it all by ourselves, but we can do better for our households from generation to generation. So Cassandra, Allan, thank you so much for your contribution to the Black Enterprise Wealth Building and Real Estate Summit.
Thank you.
Thank you, Brother Alfred. Appreciate you.
Thank you all for joining us for the Black Enterprise Wealth Building and Real Estate Summit. We hope you're walking away with new information, new resources and tools, and fresh motivation to adopt a lifestyle of multi-generational wealth creation for you and your family. Remember, you can log back in to watch anything you missed on demand. And don't forget to share on social media using the hashtag BEWealth. Thank you to all of our speakers for sharing their expertise, and an extra special thanks to our sponsors, including Walmart and Bank of America, for joining us to present this important event. Join us next month for our Small Business Summit, as well as our 40 Under 40 Summit sponsored by Amazon. For more information, go to blackenterprise.com/BE events. The message today was loud and clear. You have to take control of your finances and invest in yourself to build wealth. Now it's time to put what we've learned into action. Let's focus on closing America's racial wealth gap.